Hello, today we're going to talk about a question that we are often asked, and that question is, do I not pay points or do I pay points up front? And the reason you do want to pay points is that you have an opportunity to buy the interest rate down at your closing in order to guarantee a lower interest rate for the life of the loan, which will improve your cash flow and lower your interest expenses over the next 30 years. The downside of that, though, is you do give up cash up front in exchange for that lower payment. So there's two questions typically that you break down in figuring out, is this a viable option? And number one is, what do I value most? Do I value cash flow and interest savings, or do I value liquidity, not giving up that cash up front? The second part is also, at what point, if I decide to move forward with buying the interest rate down, what point is my break even where I have recovered all my costs between the money up front and the cash flow savings? So how long do I need to live in the house, or how long do I need to hold on to the mortgage before I start getting ahead? All right, so let's take a look at this scenario right here. And before we get started, this is just a case study. And every household has a different situation. As you may or may not know, mortgage rates and fees are all different for each household and are based on an individual's FICO score, their debt to income ratio, the amount of down payment, the amount of reserves that they have, as well as a number of other factors. So everyone's situation is going to be different, so please make sure to contact your lender. All right, let's get started here. We have a no points option here and pay 1 point option. And we can see that the loan amount in both cases is $340,000. Now 1 point represents 1% of the loan amount. So in this case, that 1 point here is representing $3,400 that will be added to your closing costs. The no point option, you can see here the interest rate is 4.5% on this 30-year fixed rate. And if you buy it down to 4.25%, you can see the payments differential is $2,147 and now is $2,097. These do include taxes and insurance, but the net result is a savings per month of $50.13. So real simple math here. And what we're going to do is we're going to bring a calculator over here, and to simply figure out what is the break-even point here when you're buying a home, and let's plug in the two numbers, 3,400 divided by 50.13, and there's your answer. It's going to be 67.82 months, or roughly nearly just under 6 years to break even. So if you're going to give up the cash up front to lower your monthly payment, you need to live in the home for at least 6 years or greater, and also, or hold on to the mortgage. Don't refinance before that point. Otherwise, you'll be in the negative. The other question is, well, is $50 enough of a gain in cash flow to give up $3,400 up front? That's a question only you can answer. But at least you know what to look at when you're trying to figure out what is the best option for you and how to calculate the break-even point. If you have any questions, feel free to give us a call. We'd love to hear your feedback. Thanks for joining us.